Hey everybody, in this video we're going to finish out the homework for chapter 13 and look through the different problems here with our tabs, etc. So let's start on the discussion questions section. Let's give ourselves a little more space here and insert a text box. And I like to get rid of the grid lines here, especially when we're just doing narrative problems. Okay, so describe in your own words why you think that financial ratios and analysis are included in both the financial accounting class and the managerial accounting class. So for those of you, and I think it's all of you who would have had as a prerequisite accounting too, we did quite a bit of, financial ratios throughout the problems, right? And we did throughout the chapters, I should say, things like accounts receivable turnover in the chapter where we talked about accounts receivable, or inventory turnover in the inventory chapter where we're looking at LIFO and FIFO, etc. So hopefully that part makes sense on what we're talking about as far as including both of this information in both of the classes. So as far as an explanation, I think what we want to say is that the financial ratios and analysis, let me say analyses, are based off of accounting data and a solid understanding of the source of that accounting data, such as is taught in the financial accounting class, is paramount to being able to understand the ratios. In addition, give myself a little more room here. While financial accounting can often be more backwards looking, managerial accountants can use the metrics, or I'll say the ratios and analyses, to drive decision making and make forecasts, or to drive decision making and to develop forecasts, goals, strategies, etc., all in a more forward looking manner. Thus, both disciplines overlap in this regard and complement one another. Okay, how does inventory turnover provide information about a company's short-term liquidity? Let's do our text box here. Oops, that's not what I wanted. Insert this one. So in terms of inventory turnover, if a company has a high inventory turnover, that means that more sales of inventory are occurring, and thus more cash inflow is happening, assuming that the AR turnover is also in let's say, just a healthy range. Because you could have a lot of sales of inventory happening, but if your customers aren't paying you, that could be bad. And so having more cash inflow will mean that the company has more liquid assets, i.e. cash, to use to pay its liabilities and fund ongoing operations. So, important concept. I mean, you can have a lot of sales happening, but if those sales aren't turning into cash received, that can be an issue. But a quick high inventory turnover kind of indicates at least that important first step, because if you don't have high inventory turnover, that can mean you'd have, and then you could have some high dollar value assets. Maybe some companies do have relatively low liquidity, possibly because they're producing items to sell that are large or really expensive, etc. And so, they would have a low inventory turnover. But again, that would kind of lead into the idea that typically, possibly that company also has low liquidity levels and might need to have more lines of credit or debt financing to keep their operations going, which might just be a necessity for the business. But all those metrics and concepts, like you said, overlap and are important at assessing the state of the business, or in really just understanding where the risks are and how to best manage those risks, right? Because if the risk is not having enough liquid capital, then you might need to have some contingency plans in place, like having more bank loan or bank access to credit, I should say, to fund operations, or doing something like just-in-time inventory, where you're not buying inventory until it's ready to be sold, that kind of thing. So it's not that it's good or bad necessarily. I mean, generally having more liquidity is typically a good thing, but it might just be indicative of the industry that that's just a risk that you have to face. And then as managers, we just need to address that risk, appropriately. Okay, so what does a relatively high accounts receivable turnover indicate? That, kind of as noted, I'm just going to say as noted above, high AR turnover means that cash receipts are happening more often, and thus the company will have more access to liquid assets. Okay, so why is a company's capital structure as measured by debt and equity ratios important to financial statement analysis? So let's see. Sorry, I keep going back. Not this insert, not that one. Okay, so a company with higher debt levels, i.e. higher leverage, that's kind of the term there, is that you're leveraging debt to fund the operations, is at risk of potentially not being able to make ongoing debt service payments, which is a risk that should be addressed. High leverage typically leads to more risk and less margin for error in operations, and is usually not desirable. So we'll just leave it at that. I mean, again, all of this comes back to what's your industry, what decisions are we making? And so as managers, we just have to know what we're looking at, what our plans are, and, have a good kind of risk management program in place and make sure that you're not over leveraging yourself. And then, because if you do that, some kind of small, or maybe not small, but if there's turbulence in your industry, or you just have less ability to absorb issues, which could lead to operations failure, basically. Okay, which items are usually assigned a 100% value on a common size balance sheet? So we'll just say on the balance sheet, total assets is typically the 100% value base, and on the income statement, it is typically sales, net sales, revenue, etc. So you might say, different. Potentially, it could be net sales instead of sales. But really, the idea is we're trying to see how much are all of our expenses as a percent of our revenue, basically. Okay, so that's great. Let's move on to the next section here. Okay, so complete the annual dollar changes and percent change for each of the following. So we've got our short-term investments, accounts receivable. I'm just going to here do this. So I think this is probably the best way to add just a couple spots here, and then we can say dollar change and percent change. So then we can just take the difference, and having it just kind of in that same format is sort of nice. We've lost our little deal there. Okay, now the percent change then is just taking the the new minus old, which is this number, right? We took current minus prior, or new minus old, and then we divide by the old figure that we're looking at, make that into a percent, and then we can just try to see if I do that. Now it gets rid of it again. I like to keep my little bottom line there looking good. Okay, so then we get a certain percentage change that looks like that. Didn't really need any extra space there. So clean that up. And then we're going to say, use the following information to determine the 2002, 2003, or whatever that is, common size percents for cost of goods sold using net sales as a base, and then the trend percents for net sales using 2001 as a base there. So let's do one little thing here. Let's insert. So we're going to just highlight down and then insert a little columns here. And I'm just going to do this as well because I like it when they line up a little better. Okay. So then we want to say our percent changes. So the first thing we use is the 3 and 2 common size percents for cost of goods sold using net sales as the base, and then trend percent. So as far as the trend percent goes, or the first thing, let's just do this. Let's do the horizontal first since that asks us. So we basically just want to take cost of goods sold divided by our base there, and then essentially, this one, you just take this. Everything is divided by net sales, including net sales. And so that's where you'll see the 100% amount there. And then we'll do this same breakdown there to the side. So that just gives us the amounts there. And let's just highlight this is common size, or we'll just put 1 because that was the first step. Oh, geez. Let's make it negative. We just want that as text. Okay, and then for number 2, let's just copy this whole thing down here, put it in like so. And for this one, what we want to do is show, trend percentages. So I'm going to delete this, shift sales left so we get kind of back to a good spot there. I'm going to delete this here, and then let's say let's change the title to trend percent, and then we could just base this off of the amounts above here. And so that's 100% basically. And we're just going to divide by the base here every time. I'll make that a percent here in one moment. What am I missing there? Is that 40? Oh, funny. The answer key has the wrong number in there a little bit. It says 42, but then they use 48 as the driver. So, yeah. So that's all we're doing is we're just taking each one of these numbers, divide by the base year, which is the first year essentially. So pretty easy, nothing too difficult from a math perspective in this chapter. Okay, let's look at our exercise here. All right, so now let's take a look at the EX tab here. And so in this problem, let's take our grid lines off here. We've got financial statements for this company, and in these financials, we're looking at a 3-year comparison, 2018 to 2020. And similarly down here for our balance sheet income statement, and we need to compute each year's current ratio, express the income statement data and balance sheet data in common size percents. So that's going to be essentially doing like doing a vertical analysis, basically, using sales as the base for the income statement, and then total assets as the base for the balance sheet. And then we need to do some trend analysis on express the balance sheet data only in trend percents with 2018 as the base year. And then we need to comment on any significant relations revealed by the ratios and percents computed. Okay, so let's take these kind of one at a time. I think one way to maybe do this here, I'm just going to copy and then say, excuse me, and then say current ratio and then when we're doing, oh, you know what, actually we should, let's put it down here. How about that? Yeah, that looks good. Okay, so we're doing our current ratio is going to be current assets divided by current liabilities. Pretty basic percentage rate, metric. And when we're looking at calculating this, we can do a percentage, but sometimes it's better to do, I think on this one, a decimal. Either one was the same information essentially, but basically what we're saying with the decimal, it's, at least in my brain, it's a little easier to compute and translate that result into the fact that current assets is 2.4 times larger than current liabilities. So that is relatively good to see. You want to have current assets. Generally, you'd want to have a decent buffer when you're looking at assets compared to liabilities, so that you've got enough room to kind of pay the current liabilities down. So I'm just going to format this a little bit. Okay, so there's our current ratio. That's number one. Number two, we're going to, like it mentions here, express the income statement data and balance sheet data in common size percents. So I think one way to do this that makes the most sense is to just insert some rows here. Those are probably a little bit long. I'm not sure why that one is. Oh, shoot. Okay, there's some kind of merge cell there. So the column width is about 12. I just like to get these relatively consistent. So there we go. Okay, and then as I mentioned, what we're going to be doing when we're doing our common size financial statement is essentially another way to say that vertical analysis. And so we're going to want to take our base here, and that's our, the base will be sales. Let's do the first division here. Then I'm going to click that F4 to give me the dollar signs around my formula there. Let's put these into percents. let's copy and paste that over to the side here. And then let's, oh shoot, okay. I'm trying to see if I can just paste this in because we want to do that for 2018 as well. So there we go. Okay, so we just need to manually correct that locked cell with the dollar signs there. And the reason, again, we want those dollar signs is because then we can just drag this down and it will continue to refer back to the sales as our base. And so if we just drag these down real easy, every number, beyond that, because we have the dollar signs, is just going to be dividing back to the totals there. So one thing that's kind of nice sometimes is just doing the format painter as well. Oh, that looks funky. Why does that look so weird? Yeah, I don't know. That looks weird to me. I'm just gonna leave it like that. So that's how we're doing it for our income statement. And then again, I'm just gonna kind of copy and paste down my formula and then manually adjust the denominator, as we mentioned, to be total assets. And so if we fix the D30 cell here, then again we can just real easily drag that down. There's a little space there, so watch out for that. You can just copy and paste these once you've got that whole formula. Actually, you don't want to just paste the whole formula because it's going to link to the locked cell. So just be careful when it is a really handy way to do formulas to make them lock that way, so you can just drag them down. But do be careful that you don't end up copying and pasting somewhere else and then forget to update, and it still is referring back to the original, like this cell, because that's really what that those dollar signs are going to do, is continue to refer back to whatever cell it was originally, unless you manually adjust it like we've kind of done here. So perfect. Okay, cool. So then you can see, as a proportion of sales, here's what the numbers are, for each year, or sorry, for total assets, and then total sales up in our income statement. And then we want to express the balance sheet data only in trend percents with 2018 as the base year. So I think I have an idea of how to do this effectively. So I'm going to give myself a bunch of space. Then I'm going to highlight all these rows here, copy, and then insert copied cells. So now we have a copy basically of what we just did. I'm going to delete this one out just because we don't really care about that, having that again. But we're going to do this version just in, and I'm going to hold down Control. You see how I'm highlighting everything as it goes there, and oh, that's kind of funny. All right, I think I need to. Oh well, okay, let's not do that. There's some merged cells and stuff that are making this a little funky. I'm just going to delete that information out so that we've got that common size information above. And what we want to do in terms of doing the balance sheet as a trend analysis is we're just going to go through, and we don't need all this space now. Let me bring that back up. So as far as doing the trend analysis, then everything in 2018, what we're going to be doing is divide this by that, divide this by that, and then divide this by this, divide this by this. So all of the 2018 amounts are just going to be 100%, just for the sake of format. Oh, again with the weirdness. I guess as a percent, it just makes it look funny when you do that. So I'm just not going to do that. Okay, I'm just going to go percentages. No, okay, good enough. So again, this is just taking, really we're just dividing each one of these by itself. Nothing too interesting there, but I guess the one thing I would say, and keep this in mind, is that if you're ever doing these analyses and you're trying to figure out what the base is, look for the 100%, and that's what everything else will be divided by, essentially. in this instance, total liabilities and equity equal total assets. So it's kind of the same thing there. But here we can see, okay, if you were to look at this and try and figure out, or let's do it here. So we're essentially going to be linking back to that first year, and then actually I'm going to do, let's see, how do we want to do this easiest? Yeah, I think just dragging down, and then you you'll see when we link into the formulas, it's just going to continuously, as we're dragging these down, take the next year divided by the base year, the next year divided by the base year, and then we can do the same thing up here, divided by the base year, drag that down, format paint just to kind of get these looking consistent. And then, yeah, we can basically do the same thing. We can really just kind of copy and paste this in here because it's going to continue to work from a formula perspective. And so we're just taking every new year and dividing it by that base year, right? For this common stock, it's going common stock 2020 divided by common stock 2018. So really, we're just seeing what these numbers are as a dividing as a percent of the base year there, which in our instance is 2018. And you can see how that kind of goes across. And yeah, okay, so that looks good. Now we're on to the last part of the problem here. Oh, we can check ourselves for this one. So 2020 total assets trend 124.3. I guess let's give ourselves a little decimals. So yep, that looks good. Okay, comment on any significant relations revealed by the ratios and percents computed. So then if we take a look here, yeah, let's just kind of look back, and you're looking up and down, but you're also looking across to see if there's been any interesting changes. Cost of goods sold as a percent of sales has been decreasing, so that's positive. Selling expenses have been increasing, so that's kind of negative. Admin expenses increasing. Overall, total expenses are trending upwards. But net income is trending up a bunch, so that's good to see. Quite a bit there. Let's look down on the balance sheet here. So on the balance sheet, then we've got current assets as a percent of assets, dropped down in 2019, but then came back up. So it's relatively promising to see, generally speaking. And long-term investments went to zero, so you can kind of see that trending off to be gone. Plant assets up. Looks like we sold off something or had some significant depreciation or something. Looks like we purchased something in 2019 that rose up to get a higher number there. And then liabilities wise, we're dropping down on liabilities, so that's looking good. That's reflected in our current ratio as well, that our current assets are going up and our current liabilities have been going down. Common stock, so you can see we had an infusion of money in terms of common stock issuance in 2019 and maintained that. And then let's look at our trends from balance sheet. So current assets, again, up quite a bit. Trend wise. Make sure that worked. Yeah, well, I should say below what they were in 2018, I guess I should say, but they did come back up from 2019. Plant assets here, generally down, generally up from 2018, like we talked about. And so, yeah, so anyway, that's kind of the overall gist. Let's go ahead and put I'm going to insert a text box here, and we can just sort of summarize what we just looked at. So I think the first thing that we were analyzing here, and we'll just call this notes, COGS as a percent of sales decreasing annually, which is causing gross profit to rise. Let's see, selling and admin expenses have been increasing. And let's see what totals there. And I guess we could look and see, okay, what proportion, total expenses here of 21.5, 22.6, 23.2. So it's relatively a consistent change, but you can kind of see one thing to note as well is, look at the totals here. So we're talking about a $20,000 increase, like 23, then another $23,000 increase, it looks like. Whereas with the cost of goods sold going down, we're looking at a pretty significant amount there, at least as a proportion. Now, cost of goods sold is increasing, but it is, decreasing, but it looks like it's a bigger, proportion change and bigger dollar amount than the sales, which is helping lead to net income increase overall. And we can note that too. So let's see, how do we want to say that? Combination of annual fluctuations leading to overall net income increase. Thus, financial trends appear positive overall, or maybe we'll say healthy. Okay, let's come down here to the balance sheet. So as far as what we were looking at on the balance sheet, we had plant assets go up quite a bit. So plant assets increased significantly in 2019, which appears to coincide with a reduction in current assets percentage. And you can sort of look down, see, okay, liabilities did not, there's no long-term liabilities. So it kind of looks to me, and the current liabilities would stayed about the same. This will say with no related increase in long-term liabilities or current liabilities. Thus, it appears that the purchased plant assets in 2019 was accomplished using current assets, likely cash. So generally a good thing. And then we kind of see our, we're not taking on debt. So as long as we are okay with the liquidity perspective and having enough cash on hand, then we're avoiding interest expense and taking on debt. We did have a stock issuance. Maybe we should mention that by using current assets, liquidation of investments, and a stock issuance, because we did have a relatively significant increase there. So generally speaking, you'd rather raise funds through a stock issuance because there's no definitive ongoing payments, related to a stock issuance or ownership. And so as opposed to like getting a loan, if we get money from new owners, the company goes, there's no obligation. This ownership percentage is more of a on the owners essentially. And so there's no obligation to make continuous payments back to those owners, ongoing, like you would have to do with bonds or other types of long-term debt. Let's see. Yeah, and then we can say current ratio recovered from the 2019 purchase of long-term plant assets. Thus, liquidity, whatever I say, thus liquidity strength appears to be recovering. Okay, I think that's probably good as far as what we've seen on all the trends there. So, just by kind of looking through things, you start to sort of see a picture of what probably happened, even if you don't know exactly what happened. You can get this sense of, hey, no new long-term investments popped up, but we did see, new stock. We saw long-term investments decrease down to zero, plant assets go up a lot, and then current assets decrease quite a bit. So it just tells the story of how something like the purchase of those plant assets was accomplished. All right, let's click over to our PR tab. Note all 5 steps are part of the same problem. Okay, so we've got 5 steps broken out here. Just gonna format those so we can see everything. Yeah, let's take a look. So we've got Nabisco Company's year-end balance sheet, and we first want to express the balance sheets in common size percents and round amounts to the nearest 1/10 of 8%, analyze and comment on the results. Okay, so let's see if we can just insert and shift cells to the right. Cool. And then it's just kind of nice to be able to do our work right there. Use my format painter just to. Oh, why did that not work? There we go. Get my little line looking good. Okay, so if we want to do our common size balance sheet, right, we're going to want to use our total assets, and we're just doing the balance sheet, so we don't have to think about the sales as a base. So we can do that initial calculation there, and then let's lock the denominator, the base, as total assets. And actually, it kind of makes sense to have it in the middle there, and then just, drag up. It makes it look kind of funny there, but let's just format paint and get things consistent, okay? So now we've got that, and then again, just copy one of the formulas down, fix the denominator. So it's, and actually, we don't even need to fix the denominator because everything is by current assets. So sorry, we don't need to do that. We can just continue to paste that formula throughout. And just to make our Excel look really nice and clean. Okay. And then we will want one more spot there. And then, let's go ahead and do those two. And again, see how the locked cell would kind of mess it up at first because it's still going to refer back to that 2020, but we can just manually correct. And then drag down, copy and paste all the way through, or drag these down. And then just do format painter, and now we're looking pretty good. Analyze and comment. Oh, I guess we got to go to show 1/10. I think that's 2 decimal places. So comment on the results. So let's insert a text box here. Okay, and now in order to determine the or to analyze the results, let's just take a quick look through. So we can see that cash as a percent of assets has decreased. Accounts receivables on the rise. Inventories on the rise. Prepaid expenses are pretty consistent. Plant assets are decreasing year over year, and they're actually increasing in dollar amount, but becoming less of a percentage of total assets, with inventory increasing so much or AR really going up quite a lot as well. So let's just write this in as we're going. So cash is decreasing, may present liquidity issues. We don't know, that's just need more information, but just highlighting the things that are kind of pertinent. AP is really on the rise as well, and AR is on the rise as well. So AR and AP are both increasing. This does indicate liquidity issues, as collections are not occurring at a constant rate, and liability payments are also not occurring at a constant rate. So both those things are essentially saying we're not collecting as much money, so we can't pay down our debts as fast. So it's a little spooky. You might be a little worried about that. Plant, we might need to do more work on collections from customers. Plant assets are increasing, but decreasing as a percent of total assets due to AR increase. And then inventory has gone up relatively significantly as well. We may need to analyze inventory turnover ratios to see if inventory is backing up, or let's say is getting backed up, which could cause issues such as increased costs related to inventory storage or inventory spoilage. Yeah, so if the inventory is sitting around too long, that might be a problem, right? Our notes payable is not going up a bunch, so we haven't had to utilize debt too significantly. Long-term debt amounts are decreasing and thus don't appear to be being heavily relied on to finance operations, which is positive, but liquidity issues could cause this to change in the future. So the company might need to start relying on more debt, as we can see some of these other liquidity related metrics becoming more negative, essentially. Okay, step 2, refer to our balance sheet. Step 1, analyze its year-end short-term liquidity position by computing the current ratio and the acid test ratio. Okay, so let's just put some. Let's see what I want to do. I'm going to unmerge those because we don't need all that. We need space for our calculations here. So we'll do 2020, 2019, 2018. I will merge these cells here and say current ratio. So now we've got a spot to kind of calculate through our current ratio, and then I'll copy that whole thing, put it down, and say the acid test ratio, or quick ratio is another name for that. And I'm just going to leave it over there. Okay, so here we've got our, we want to do current liabilities divided by current assets. And so current liabilities are going to be everything other than our plant. So yeah, current ratio or current assets there of 293 to 258. And then when it comes to current liabilities, we just have accounts payable. So we've got this formula adding up all of our current assets. So I'm just going to put parentheses around those to have that just be that one number essentially, and then put divided by total current liabilities. And so in our instance here, we have what, 1.84. And we'll just copy. Oh, I can't. Oh, shoot. Okay, well, let's copy and paste this. We want to change all these to the G column. So one way to do this really easy, here's a little trick, is that go to this find and select, and it will only find what's in the selection that you have. And then click replace, and we can go replace F, because it's currently showing all these F's here, and we want them with G. And if you push replace, then it just changes all those references to the right one there. And then we can do this basically again. And now we can say change all of them from H, because H is the percentages column, to I. And once you change it to I, now it's referring to the right column there. Okay, and then when it comes to the acid test ratio, then really the only thing, we look at, they call them quick assets. And so in this instance, or in general, I'm going to do the parentheses just to start. Quick assets would be accounts or cash, accounts receivable. And if there were any, it would be short-term investments, but we don't have any in this instance. So we're going to take that total, divide by accounts payable now. And let's see, did I miss anything? Nope. Okay, that looks good. Then again, we can just drag this across, but we're going to need to change this out for G. We'll just do it manually now. We did it, with the little quick deal there. And then we'll change these all to I. Different ways to accomplish the same goal. If you have a whole bunch of these ones, had some more. So, the more cell references you need to change, maybe the more beneficial it is to use that kind of technique of doing the replace. Okay, and then we want to comment on our results again. So let's go insert a text box here. And what do we want to say about the results? I think we've already kind of spoke to what's going to happen up here, but we can essentially say both the current ratio and the acid test ratio have decreased, which indicates a liquidity problem. Liquidity, as further noted and described above. Okie dokie. All right, let's go to step 3. So the company's income statements for the years ended there follow. Assume that this is the next income statement just for those 2 years. Okay, so assume that all sales are on credit, and then compute for both years the days sales uncollected, accounts receivable turnover, inventory turnover, and the days sales and inventory. Again, comment on the changes. So let's see, where do we want to put this at? I think we'll just do, let's get some extra space here, and we'll just put these in going this way. So the first one will be days sales uncollected. Then we're going to do AR turnover, inventory turnover, days sales in inventory. Okay, and okay, so days sales uncollected is going to be our I want to do that. Let's do so. We're basically going to do and put headers on this as well, or sorry, like the header to that. Let's do this. We just do it like this: 2019, 2020. That's fine. This kind of looks different. Okay. Sorry, I'm just gonna cleaning this whole thing up. So if we really want this to look nice, let's merge these cells. We can use the format painter. Click, click, and it's just going to merge those cells so that when we do our cell borders there, it just makes a nice little table for us. Okay, so when we are talking about our days sales uncollected, our denominator is going to be the sales, and what is our numerator? I have to actually refresh myself on this. So AR divided by net. I think it's I want to say average AR, but I need to refresh myself on whether it's average AR or just ending AR. Bear with me for one moment. Okay, so it's not, just ending, it's ending AR, not average AR. So when we're looking for what we want from that perspective, we're just going to take that ending balance. And our formula for that is going to be AR divided by net sales, and then multiplied by 365 to get the number of days. So again, AR divided by sales times 365. And then let's bring that down a little bit. Round the amounts to one decimal. Okay, there you go. Okay, then we got to fix our formula. So you paste it over, but a lot of times you got to go through and make sure you update the formulas correctly there. So then you've got 50 days versus 56. So it's just kind of a metric to say, on average, using these metrics, we have 56 days that we've been making sales that still are waiting to be collected, and that is increasing. So one of the biggest things is just looking at that and saying, okay, well, it's going up, and that kind of ties in with what we've already analyzed when the liquidity above, not the best thing to see. Okay, so then we're going to look at our AR turnover, and in this instance, this one we are going to want to do average AR, but the formula is a little different. We take sales divided by average AR, and so I'm going to do two parentheses because the first thing I want to do is to just add our AR from each year, and then I want to divide that number by 2 to get an average, just a simple average of 2. And then again, we're going to paste these in, but we got to do some formula corrections here to make sure we're referencing the right stuff. But I just find it easier to copy and paste and then fix the formula than to try to retype it in. So again, AR turnover is going down, so that indicates that we're not collecting, our total AR is going down of being collected each year from 8 times to 7. And then inventory turnover is a similar thing. pretty similar formula, but we're going to use cost of goods sold instead of sales as our numerator. So cost of goods sold, and then we're going to use inventory instead of AR. Oh, that actually works. So nice. Sometimes it just works out. The formula is kind of set up for that. So again, cost of goods sold, these should have gone down correctly. So we're now referencing AR. So that's cool. 4.4. So awesome. And then days sales in inventory is us taking ending inventory divided by cost of goods sold, and then multiply that percentage by 365. So we get 120 days exactly. And then let's do the same thing here. Move our formula to the right spot there. So then COGS for 2019 divided by ending inventory. And as we can see, days sales and inventory has gone up quite a bit, which again speaks to that whole fact of the inventory kind of buildup that's happening and potential, glut or backlog, bottleneck or something, where we might have costs, for storage. Maybe we are talking about Nabisco, I think. So yeah, there's some risk of our inventory spoiling, going bad, so on and so forth. So that's not great. All right, step 4. Oh, I guess we have to do our little analysis here. Let's just copy our table there. I'm just bringing this down. I like to be kind of clean and make it the same size there. And I mean, there's not really anything more to say other than all of the ratios here speak to decreases in efficiency and liquidity, trends, the company, or what do we want to kind of say, the oversight of operations appears to be worsening for some reason. Okay, step 4. Here we're saying compare the company's long-term risk and capital structures by using these ratios: debt and equity ratio, debt to equity, and times interest earned. So let's go ahead and just copy. Again, those, these aren't going to work at all, but let's just use this general structure. Debt and equity ratio, our debt to equity ratio, and then times interest earned. Okay, so we want to figure out essentially how has the changes happened in our, like we were talking about debt and liabilities, etc., and kind of see how those are impacting overall. So what has changed as a proportion of total equity and debt? So is this going to work? Trying to see if this will work for us. The way that we really want to do the debt and equity ratio, I think, is by breaking these out more so in sort of that vertical presentation. And so, debt to equity. And this is not often debt and equity ratio. Mark, so we look at let's just do the first one. I think we're gonna have to do the debt and equity ratio a little differently. Debt to equity ratio is really simple. We just take our total liabilities. So we just add those together because it doesn't have a summation total. Actually, let's put parentheses though. So we get total liabilities, debt to equity, and then divide by our equity, which again, we need parentheses there to get common stock and retained earnings. Okay, and so let's see. What does it tell us? So we can 78.38, or if we were to say, as a decimal, 0.78 to 1, that would be year, the current year. And then we can drag that formula over, but again, let's fix this almost might be one we'd want to use that replace trick, but that's okay. We'll just pull those over. So debt to equity, debt is increasing as a percentage of equity, so that's not really all that great. And make sure I've got all the formulas as we've got 221, 896, yeah, and then 3, the totals there. So if you wanted to kind of get this would be easier if we had subtotals in this. So it's a little bit annoying just to have to do it that way, but that's okay. Okay, now we want our times interest earned ratio, which is basically going to the term is the EBIT, EBIT, not debit, but EBIT, earnings before interest and taxes. I don't think, do we break out? We don't have taxes broken out, I don't think, in this one. Oh, we do. Okay, sorry. So we want to figure out our EBIT, and then we're going to divide that by the total amount of interest, or remove that amount. Let's see, what's a better way to say that? Sorry, I'm not saying this well. We want to take net income, and then, so net income of 38,793, back out income taxes and interest expense. And so if we were to do that, let's see, did that work right? Oh no, sorry, not minus, because that'd be subtracting it twice. So it kind of shows funny because it's a positive number, but it is a decrease. So net income plus add back those amounts, subtracting the expenses essentially. So before those expenses of interest and income taxes, our net income was 59,868. And so then we take that amount divided by the total interest, and it tells us, backing out those factors, our net income is 7.3 times higher than what our interest expenses were. Same deal here. We can just move these over. So that's good to see that our increase in the times interest earn ratio is at least positive. Most things are kind of going in the negative direction. And so the debt and we've got to do this little fix on this first one. So debt and equity ratio is let's see, how do we want to present this? I think the best way is just to do, let's take this, let's create kind of a, I'm just going to copy this table, paste this in, and let's say liabilities. Liabilities and debt here for the first top part, liabilities and debt, and then equity. So let's calculate those subtotals for us, because I think that's what we're going to need to do here. So in 2020, our liabilities and debt was the two amounts there. So what was it? 276,195. Total equity is the combination of these two. Maybe I should have done that first, because we actually did use some of those same metrics down there, but that's okay. So then we're going to, again, just kind of copy this over, fix that formula. Boom. Same thing, fixing the formula here. Boom. Okay, so now we've got total liabilities and debt. We have total equity. And then we can just basically, what I think here we need to do, and let's, in order to do this, add an extra space there. And we're basically kind of doing, like I was mentioning, sort of that similar thing to the common size financial statement or the vertical analysis. And so, oh yeah, let's do this. Sorry. Let me add one more spot here, because this will make it more clear. And we'll say liabilities plus equity. So this is just our total. Okay, and then we're doing, like we were talking about, just that kind of horizontal analysis type of thing, where when we have 100%, that's our base, is going to be total liabilities and equity. It would actually be the same thing as assets, because remember, assets equal total liabilities plus equity. So that tells us, I'll clean it up. When I do these horizontals, I kind of like to put it in the middle, at least, because it's really more referring to this, not to this. So I kind of like to have it closer to that spot there, but that's just me. Okay, let's add our analysis bubble text box here. And let's see, what do we want to say? So debt to equity is increasing, which shows that increases in debt exceeded the increases in equity. So, like I mentioned before, I think a different problem, but it doesn't seem like we're seeing this yet, because our times interest earned is still okay. But really, the driver, the primary driver, is the increase in accounts payable, and thus the times interest earned ratio improved from prior year. However, if current ratios continue, it is likely that the company will continue to increase debt as a percent of equity, and will likely see degradation in times interest earned in the future. So that's just kind of maybe predicting a little bit about what could happen, is that, if we continue to see these issues with the liquidity and all the rest of it, then you get to a position where, we're not having to take out a lot of debt currently, but if we're continuing to see cash flow issues, unless we can fix that problem, then to continue operations, it's likely that you will see some increase in debt going forward. And then eventually, once the interest from that debt starts piling up and you're having to make those payments, that's when the times interest earned ratio starts to get worse. And in the worst case scenario, then the company can't manage its debt service payments. And, that's when things really start kind of the wheels falling off of everything. So, okay. Here we're going to evaluate the efficiency and profitability. So we want to do profit margin, total asset turnover, and return on total assets. So let's again take our little table here. But we're going to do, and I'm just going to copy these in here. Oops. just instead of typing, just to kind of show you all how to, so you can click in, double click in, and then you can edit inside of cells, and you can highlight and do Control C, and then double click into that cell, Control V. So just, different ways to sort of manipulate edit the Excel narrative data. Okay, so the first one we want to do is our profit margin. And so we want gross profit. Again, this problem doesn't do a lot of subtotals, I think, because it wants you to calculate a few of these. But remember, gross profit is sales minus cost of goods sold. So we're just going to do that minus that. Whoop. So gross profit is $267,150, and then we're going to divide that by sales. And what do we end up with? Let me make sure I did that right. What was the first part? Our profit margin. Yes, 685 minus 417. There we go. My answer is not agreeing to the answer key as I'm looking at this, but so sorry, we're doing profit margin. That's why I'm a dummy. That's gross margin ratio. We want the profit margin ratio. So profit margin ratio is net income divided by sales, which gives us this total here. Or if we do it as a percent, 5.66%. And then let's just fix ourselves over here. Boom, boom. Okay, so now total asset turnover. We're going to want to take our total sales divided by our average total assets. So average total assets, let's do this here. So total sales first, divided by, and then do parentheses so we can add and then divide. Current year total assets, prior year total assets, divided by 2. I'm almost getting to the end of my recording time here. Keep an eye on that. Okay. But let's see, what did we do wrong there? Okay, I think this got a little funny. I think we need 2 parentheses. And then, yeah, so it's a 1.17. Yeah, you got to be careful with your parentheses, because sometimes if you don't have that extra parentheses, it thinks divide the whole thing by 2, which is not what you want. You just want the average total assets. So 1.14 to 1.17. Profit margin decreased. Not good. Return on total assets then is going to be our net income divided by that average. Same. So, one way to kind of do this, let's just copy this formula, drop down, paste that formula in. Again, it's going to be doing kind of the same thing there, but it's taking that was a gross, the profit margin, total asset turnover. So instead of taking sales for the return on total assets, we do the same denominator, but now we use net income as the numerator. And so that's just, sort of a little bit of a handy way to show, or, just to take one formula and kind of convert it without having to reinvent the wheel, other than just dragging this from sales to net income now. Okay. Okay, so I think that all looks good. So return on total assets decreasing, profit margin going down, total asset turnover coming up a little bit. But let's do our analysis here, and say profit margin decline and return on total assets decline support the fact that operating efficiency declined. Total asset turnover is not, so it's so small that it's not really significant. So we'll just leave it at that. And yeah, this poor company is not doing well, and now we've analyzed all their failures. So everything looks like it's in maybe a dire position. So as a board member, for example, if you were overseeing this company's management, you might have some pointed questions. Okay, now we're on to the Beyond the Numbers tab here. And in this one, it says, select one of the following categories of ratio analysis, explain what the ratios in that category, measure, choose. I think there's part that's missing, so I'm going to insert there. Okay, choose one ratio from the category selected, present its formula, and explain what it measures. So I will let you all do that, but you can find those, categories and what are ratios that fall in those very easily, either through an online search or looking in the glossary of the book at the end of the chapter, etc., in the notes, a lot of places. So just go through, find one of those specific, gross profit margin. You can even sort of, refer back to this and say, oh, we want to analyze liquidity, for example, or if we want to analyze profit and efficiency, we can look at profit margin ratio, asset turnover, so on and so forth. So solvency, things like current assets, current ratio. So this one's actually a pretty easy Beyond the Numbers. You all just have to do a little work of selecting one and then writing out a little analysis. And you can easily do that just by inserting a text box, for example, something like that. So I'll leave that up to you all. And yeah, I think the biggest, problem here obviously was this one where we had to go through and do a lot of analysis. But I think that's kind of fun. You get to sort of develop a perspective of the company and, get some of these key performance metrics. Start the ratios kind of start to tell a story, or at least it helps us tell the story from the financial statements. And sometimes that story is not always positive, as we've seen in this in this example. Sometimes businesses are struggling for a number of different reasons. Maybe there's industry issues or something, but in this one, it was really about it seemingly like operating efficiency is decreasing in terms of AR going up, AP going up, inventory increasing. So those are somewhat, more so within management's control versus maybe an external industry, macroeconomic issues or something. And so it would make you kind of question, what is management's plan? What are they doing? Are they addressing the risks? Are they, the issues appropriately, etc.? So, all right. Well, with that, I will bring this video to an end, and I appreciate you all following along. Hopefully that's helpful, and I'll see you all soon. All right. Thanks, everybody.